Okay, Tyler. So we've done a video on Dollar General. We've talked a lot about it offline. Stock's up about 15% as of this recording on the 18th of October. So the big news is the former CEO, longtime CEO, retired less than a year ago, is coming back. Now he's back. It was effective immediately, this press release, replacing the heir apparent to him, who was a longtime Dollar General operations executive, to try to turn the business around. Tyler, I think this is partially answered one of the questions that you had in our previous video was potentially the company needed a change in management. You ready to hash this out?
I think so, but I don't know if this is the management change I was looking for.
Fair enough. Fair enough. This is The Smattering. I'm Jason Hall. Of course, our videos are sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check out that link after the video. All right, Tyler. So again, I want to encourage people that kind of want to know what's going on. You're not super familiar with Dollar General. Go back and watch our prior video where we took a look at it. I think I'm a little more, I know I'm a little more bullish on it than Tyler is. Again, not as a deep value play here, but a turnaround play, because I think I like the general idea of what they're trying to do. They have not executed well on it. Tyler has some more serious concerns than I do when you start peeling the layers back and looking at the business. But in that prior video, one of the things that Tyler talked about and I talked about and that I agree with is if you look at the metrics for this company, it's grown, it's increased its store count substantially over the past decade. And for a period of time, there was some economic return. Cash flows were better, margins were better. But then we started to see kind of a steady deterioration of the results over maybe a 4 or 5 year period, if we're being honest with ourselves. This didn't just happen 11 months ago when the new CEO was named, when Bezos retired. So, Tyler, let's kind of pick up the thread with where we are now. Where do you stand? Kind of give your summary of where you stand on the company and whether you think this move with the prior CEO, who led the company through a lot of its growth and success, whether you think he's the right person to be coming in.
Well, like I said in the previous one, the only way that I could see any possibility of this being a true turnaround is you'd have to have some significant catalyst showing the turnaround possibility. Like there had to be a management change, there had to be something that show a change in attitude and a change in the way that management wants to go about how they do things. Because, we talked about this massive store growth thing or this, massive store growth expansion that they started back in like 2016. It was actually part of the previous EO's like major capital expansion plan was almost a near doubling of store footprints and to kind of add the shareholder benefit on top of it. It's like, well, yeah, we're going to do this huge expansion project, but we're also going to buy back shares at the same time and do a lot of other things. And so there was a lot of money going out the door. And when there's a lot of money going out the door and you want to buy back shares, you want to pay a dividend, you want to do all these other aspects to, increase shareholder value, you take on debt. What ended up happening is right around 2018, 2019, we started to see like a deterioration in some certain operate or return metrics that you would want to see in a business, right? Like, or the return on equity stayed about the same, but you saw a decline in return on capital. And so with that, you ended up a return on capital equity constant and a decline on capital means that you're just adding debt to kind of make up for that because the equity is a smaller portion of the total capital stack. So all of that kind of suggested to me that something was wrong with the way that they were going about this, right?
The most important part of that is it doesn't generate shareholder value. It doesn't add to the value of the equity, right? That's the big thing.
Yeah, I mean, you're keeping the return the same by, declining share count. But if you look at the total capital return of the business, it's basically coming from levering up and reducing your equity portion. It's kind of like how real estate works, right? Where you have this huge debt load and a small amount of equity, so you can kind of like lever your return because, it's real estate, right? It's supposed to consistently go up. But when you started to see some deterioration in some of those return numbers and you started to see a little bit of a slowdown in inventory turns, so basically the amount of times that they're turning over the inventory in the store started to deteriorate, it all kind of came to this sudden crash recently where everyone started looking and go, oh, wow, this is not looking great. And I think part of this is, I think part of this reaction in the market is saying, oh, well, it was the current CEO's fault. Let's bring in the prior CEO. He was the one who navigated us through this previous expansion and huge shareholder growth initiative. But my kind of take on it is like, well, this was the person who may have potentially set you up for this. And you and I had been obviously talking about Disney. And there's part of me that says that's a little similar, right? Where Iger comes in, he does this huge capital expand, great things for shareholders. Everybody's happy. The heir apparent, Bob Chapek, comes in and everyone's, oh, he ruined it, right? Well, maybe prior CEOs left the business in not as great of a position as everyone seemed to think it was. I can think of plenty of examples of this. Jack Welch at GE levered up the business into all these other different things, turns it over to Jeffrey Immelt saying, like, I've built the best business ever, but it didn't take that long before you know it, cut businesses left and right to fix themselves. I would be hesitant a little bit to say that the prior CEO who kind of started the path that led to this problem is going to be the right one to lead us out of it.
I want to kind of soften that message. I'm going to agree directionally with you, Tyler. And I think the main thing is that investors shouldn't just assume that this is a savior coming back in to save the business, a la Bob Iger, because there's a little bit of a similarity, right? Because Bob Chapek had been at Disney for a very long time before being named as Iger's successor. And then Iger comes in and replaces him. If you think about what's going on with Dollar General, because when Todd Vasos retired, he remained on the board, remained involved with the company. And less than a year later, Jeff Owen, who he's replacing, same thing. Jeff Owen had been at he'd actually been at Dollar General for longer than Vasos. He'd been there since '92 as a store level employee, led the operations organization for a very long time. So again, you've got two people that work together to lead this business in the executive suite for a really long time. So I think it's fair to say that Vasos certainly had some role to play with the company's problems. There's no doubt about it. Can he be the manager to come back in and take it back to its previous levels of profitability, return it to healthier growth, get costs in line? Maybe that's the case, because there's other examples of a CEO leaving and coming back and things working out swimmingly. Starbucks with Howard Schultz, right? This is 15 years ago. He's done this multiple times. He left and the company was kind of already set up to be in trouble when he left because of its growth strategy. It grew too quickly. Sound familiar, Dollar General investors? Same thing. Schultz came back in, reined things in, refocused the company on growth, and then the next 10 or 15 years was arguably its best ever. So there is certainly a possibility for that. You can look at Rich Templeton, Texas Instruments, one of the most incredible investments of the past 20, 25 years. Templeton retired once, is named heir apparent, left in, there was a bit of a scandal. So Templeton came back and now has recently retired about a year ago. And it looks like the new CEO that has come in has replaced him. Schultz made his third appearance as CEO at Starbucks, is now gone. And his heir apparent so far seems to be kind of taking the reins, and that business has started to get healthy and recover again. So maybe Vasos can be that stabilizing hand, Tyler, for a little bit of time. Tyler, but tell me your thoughts on this. You said there needs to be a change in leadership. This is a change in leadership, but like you said, and I think maybe you were talking about maybe more of an outside view, somebody coming in with a fresh approach to the business and reevaluating it that's not part of the existing culture and the existing business that's been built. Is that more what you were kind of hinting at?
I'm open to the idea that Vasos can indeed turn it around. That is a possible outcome, but I would have to see an actual tangible plan that involves resetting a lot of things in terms of trying to improve store returns, trying to improve inventory turns, probably looking to maybe pay down some debt rather than looking to continue doing a share buyback system, because eventually you can only go so far when you have a certain amount of debt. So those are the sort of things that I want to look at. It's kind of almost like a blocking and tackling of retail and a little bit of rebalancing of the balance sheet that would, if that's the plan, then I'm much more on board than, well, yeah, we just changed the guy.
Yeah. So to kind of sum everything up, Tyler, I think the interesting thing about it is I think you and I are actually pretty similarly minded when it comes to what's going on with Dollar General. And the difference,
yeah,
honestly,
I just give it a little bit more acerbic reaction to everything.
That is true. That is true. But I think the other part of it too is it's a little bit of the difference in our individual investing styles. I had somebody in on our Dollar General video that we did call me out and say, "What are you doing? You did a video a month ago calling it a brilliant buy." And I still think that this could turn out to be a brilliant buy. I really do. The difference, Tyler, I tend to be a little more aggressive with seeing the opportunity, and you tend to be more, let's let them earn it. Let's let them show it. Let's let them demonstrate they're improving in those key metrics. And then we can start talking about whether or not it's time to buy.
Exactly. I mean, there's other things in the market too. So like the compelling case for Dollar General has to be so good that it's not just like, yeah, I could do better. It has to be better than a lot of other options out there.